Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Saturday, March 28th, 2026, and we're looking back at the market chatter from yesterday.
That's right, Ethan. Our AI dug deep into quite a few discussions yesterday, flagging 13 different stocks. We saw a really interesting mix of sentiment, everything from strong optimism around certain sectors to some pretty vocal concerns about company fundamentals.
Definitely. While there were a good number of cautionary tales, we also spotted some promising candidates that are catching the eye of the online community, especially in areas with major geopolitical catalysts. It's a dynamic market, to say the least. All right, let's dive right in with Occidental Petroleum, OXY. The sentiment around this one is overwhelmingly bullish, Brooke. Users are talking about long oil, folks, anticipating oil prices soaring to $150 to $200 a barrel due to severe geopolitical disruptions. OXY, as a domestic U.S. shale producer, is seen as perfectly positioned to, quote, make money hand over fist. It's already up 58% this year and hitting 52-week highs.
Ethan, I hear the enthusiasm, but we have to look at the numbers. OXY's price-to-earnings ratio is quite high at 48.385, and its debt-to-equity ratio is also significant at 63.804. While the geopolitical scenario could drive earnings up, that's a lot of speculation. And trading near its 52-week high means the easy money might already be made. This would be a new rating for OXY, as it hasn't been discussed on our show before. True, but the potential upside, according to many, is still massive. Based on that strong forward-looking sentiment and the potential for a fundamental shift in profitability, I'd say OXY is a buy. Next up, let's talk about SanDisk Corporation, SNDK. Our AI flagged a post about a revenge trader switching to Amazon, which already hints at a negative past experience. While it had impressive revenue growth of 61% last year, its net profit margin is a negative 11%, and earnings per share is a concerning minus 7.45. Well, they did see a 160% surge in 2026, and there was some insider buying, a small 0.21%, which shows some confidence. Plus, whispers of a stock split might increase liquidity. But Ethan, the debt-to-equity ratio is a very high 7.96, and the price-to-book is 8.92, which looks pricey for an unprofitable company. More critically, news about Google's TurboQuant is explicitly questioning if it will end the AI memory boom. That's a direct threat to their core business. We had SNDK as a speculative gamble in our last two broadcasts, but the fundamentals here, coupled with that market threat, push it back.
Given those significant headwinds and profitability concerns, I agree. SNDK is a stay away. Moving on to Reddit, RDDT. We've got users making full-port leaps bets, showing long-term conviction, and there's decent revenue growth at nearly 70%, with a positive net profit margin. Insiders have been buying a significant 15.9% of shares, and analysts are optimistic about their AI tools. It was a speculative gamble for us recently, but before that, mostly stay away. The community sentiment is strongly bearish, Ethan. Comments like, crazy to be buying leaps when it's still dropping, and it's still way too early, are prevalent. Its current price is less than half its 52-week high, and the beta is a very high 2.419, indicating extreme volatility. That PE of 46.5 is still quite rich given its dramatic decline, suggesting future growth is heavily priced in. Plus, there's news about a social media addiction trial ruling that could introduce regulatory risk. So, despite the strong insider confidence and revenue growth, the market still feels it's too volatile for a solid entry. Precisely. The risks are too high right now. RDDT is a stay away, but one to keep a very close eye on. Now, Robinhood, Hood. We did have it as a speculative gamble back on March 11th, but before that, it was mostly stay away. I see a strong net profit margin of 42% and insider buying of almost 4% of shares, showing internal confidence. Management is also trying to redefine capital allocation with a buyback. Ethan, the social media sentiment is brutal. Peak Hood incompetence. Robinhood exists to you over. Fuckers cost me 7 figures. Users are abandoning the platform in droves for big boy brokerages. Its beta is sky high at 2.479, and while it has a good profit margin, its PE of 32.2 and P/B of 6.51 still suggests premium valuation for a company facing such a severe reputation crisis. The market wasn't even impressed by the buyback. Its debt-to-equity is also a massive 136.04. Wow, those user complaints are truly scathing. It's hard to overlook that. Indeed. The fundamentals might be trying to improve, but the public perception is a huge hurdle. This stock is facing significant headwinds. Hood is a stay away. All right, let's talk about Microsoft, MSFT. This is a company we've often had as a buy, though it was a stay away for a couple of days last week. The current sentiment shows many users are accidental long-term investors now because they bought higher, but there's a strong underlying belief. It's MSFT, you are fine. It's near its 52-week low right now, making it an attractive dip buying opportunity for some. Plus, 16.7% revenue growth and an incredible 39% net profit margin for a company of this size. And they're investing heavily in AI. Yes, the fundamentals are solid, but it's currently down 24% this year, and there was a slight net insider selling of 0.72% over the last 6 months. They also had a hiring freeze, which could signal caution. While the PE of 22.3 is reasonable for MSFT, it's not exactly a bargain basement price, even with the dip. The long-term outlook is good, but the short-term volatility is real. I think the market's long-term conviction, combined with those powerhouse KPIs and strategic AI moves, outweighs the short-term pain. The current price near the 52-week low presents a compelling entry for long-term growth. MSFT is a buy. Finally, Information Services Group, III. This is a tricky one. The only social media post we found was bullish on a company called Neuron, due to phase 3 trials citing 3x to 7x upside. It sounds like a biotech. Exactly. That sounds very promising if the phase 3 trials for evenamide are successful. A US listing could also drive up its valuation. Here's the catch, Ethan. The KPIs and news we have for the ticker III don't match that biotech. Our data shows a company with a current price of $3.76, a PE of 19.79, and a 4.79% dividend yield. This implies a profitable dividend-paying company, not a pre-revenue biotech. Oh, that's a significant discrepancy. It really is. The KPIs for this III actually show a very high debt-to-equity ratio of 74.975, and more importantly, significant net insider selling of almost 5% over the last 6 months. It's also near its 52-week low and has lost 19% in the last 4 weeks. We rated it stay away yesterday, and nothing has improved. So we can't accurately assess the Neuron play with the data we have, and the actual III ticker looks quite concerning. Absolutely. Due to the significant data mismatch and the concerning KPIs for the actual III ticker, we must maintain our stance. III is a stay away. All right, to recap our hunt for multi-baggers today. Investigate as buy. Microsoft, MSFT. Occidental Petroleum, OXY. Investigate as cautious buy. None. Investigate as speculative gamble. Reddit, RDDT.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions.
We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for joining us on the Daily Hunt for Multi-Baggers. We'll be back on Monday with more insights.